Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
I'm just going to show you a couple charts, and then I am going to take as many questions as you guys have. So here, I want you to recognize that the option premiums are based on the market perception of risk or volatility. If you take a look at October 17th, 18th here in dollar-yen, really the markets were going berserk in 2008. And if you wanted to hedge your dollar exposure, your yen exposure, what have you, well, you'd have been paying almost 34% volatility. These are 60-day options. You could pick different kinds of volatility. If I just pick 60 here, you'll notice that the amber line is the implied volatility. The blue line is what the actual pair value was doing. And you'll notice the option premiums were pretty expensive from, let's say, August all the way through relative to the underlier. And then the options actually fell below. And now they've stayed above for the last 11 months, basically, that the currencies themselves are not trading as volatile as, in a volatile fashion, I should say, as the option premiums. And how do I come to that conclusion? That amber line there, that brown line, whatever you want to call it, is above the blue line. So, and that's a pretty normal situation for options. And options tend to be trading at a little bit of a premium compared to their theoretical value or their worth because of their limited risk characteristic. So options usually will carry a little bit of a premium. Not always, but as a rule of thumb, that's the way they might trade. So this is a screenshot taken from live vol just a couple hours ago. Dollar yen, yuck is the symbol. Here is the U.S. dollar Canadian. So pretty similar. November 2008, we saw a peak at about 24%. We came from 8% earlier that year, and then we traded almost down to 8 in early April, and then went from 8 to almost 16. Now, why is it important? Well, if you sold an option at 8 volatility in April, well, no matter what happened, you probably were losing money because volatility picked up. Now, if you were buying options, let's say in September or October last year in the Canadian against the dollar, well, more than likely, no matter what happened, you see what happened. Volatility went from 16% to 10. So the trend of the volatility is important also. If you don't want to get too wrapped up in these volatilities, there's a simple way to trade these options. It's vertical spreads. Call spreads, put spreads. You can buy them, you can sell them. There's been a lot of presentations on the different strategies. You can go back to the archives, FX options, check out the archives of the webinars, and you'll see many of the guests have done presentations on that exact subject. So here it is, dollar Canadian, and we saw sort of a huge move last Wednesday, Thursday, Friday, and now we're coming back to earth, if you will. Dollar euro, whoa. So dollar euro went from about 9% or so to about 17% in a week. So that is an amazing spike of dollar euro volatility. And this is actually the dollar against the euro. This is EUI. It's going to be very, very similar, though, in euro dollar. British pound moved from about 12% to about 17%. So the euro is actually trading more stable and then even exploded more than, let's say, the British pound. Symbol here is PPX. The other symbol is EUI. You can check out, this is actually free at the ISE. You can go to fxoptions.com. I'd urge you to bookmark it. The option skew is something that could be very, very helpful for all of us traders. What you're seeing here in the different, we're looking at a couple different things. We're looking at volatility, implied volatilities in strike prices, and months. So what you'll notice in the top left, that's the euro, and you'll notice the red, I have these memorized, the legend, there's no legend here, but there should be. The red is the 1 month option, the yellow is the 2 month, I think the 3 month is the green, and then followed by dark blue and light blue. Well, when you see that the implied volatility the short-dated options is higher. That just means that people are nervous over the short term, and that might influence how you're trading. So there is some nervousness in the euro market, and that's to be expected. You'll notice that volatility tends to move up as the euro moves down. That's, again, based on the euro. If we look at the Japanese yen, the second one over the top on the right, it looks pretty much the same, although one major difference, that you don't see that panic, that red volatility, that 1 month vol, is actually much, it's sort of the same as the other month. So people trading dollar yen are not so worried about the tomorrow or the next day, where people are trading the euro. Premiums are higher because there's more perceived risk in the short term. If you look at British pound, sort of similar to the euro. So that's interesting. Again, and these skew charts help you identify where the volatility might change based on the asset value. So if you look at the first one, what it's saying, the option trader is saying if the euro weakens, that the premiums are going to get greater because it's going to weaken pretty quickly. Same thing with the yen. Same thing with the pound. Except, of course, with the yen is that the dollar is going to weaken because that's the dollar as the base currency. So you can go through, and then the one on the bottom is the Canadian dollar, and you'll see sort of the opposite. It's sort of a hockey stick to the upside, and that, again, is because the dollar is the base currency. So the dollar is the base currency. Option traders are more nervous about a huge dollar rally than they are a dollar sell-off. Now, the dollar could sell off, but the option traders are making a prediction, and if it sells off, it will do so in a very slow fashion. At least that's the prediction. These are estimations. They're by no means a guarantee. They're just an estimation. So here's the British pound. Oh, we had the British pound already. Oh, no, I'm sorry. That's the Aussie. Sorry. So there's the Aussie. And the Aussie, if you see it, that is the Australian against the dollar. And what that chart's saying is that if the dollar starts to strengthen, which means the Aussie weakens, volatility might expand. And the Swiss franc is more of a volatility. If the dollar starts to rally, we might see more volatility in the options. You see that by the slope of that line moving upward. So to summarize what I just spent the last 45 minutes on, using options to take advantage of currency market moves or hedging currency exposure does not have to be overly complicated. With increased globalization, foreign exchange markets are playing a much larger role for investors. The FX options market allows you to target income, whether you're doing, let's say, credit spreads. You could limit your risk. Again, you could use credit spreads, or you could do some protective trades, or you can hedge. FX options allow traders to participate in the currency markets without having to open a spot or future account. And all of the option strategies that are available in the equity markets are available in the IC FX options except the covered call strategy. We launched a new website about, 5 or 6 months ago. It's been a phenomenal success. We're adding more and more tools every day. So whether it's the trader forum, the new skew charts that we have, there are just so many things there. And the best thing is it's all free. So go and check out the archives. Start to talk to fellow traders, whatever. Go and bookmark the site. I think that it's worthwhile. The Trading Tools tab is really great.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.